If you've been watching the market lately, it's hard not to feel a sense of vertigo. The Nasdaq has skyrocketed nearly 30% since its April lows, climbing almost every single day. For most investors, entering at these levels feels like buying at the absolute top. The data justifies this anxiety. Over the past year, the top 10 performers in the Nasdaq 100 saw an average gain of 784%. To put that in perspective, at the peak of the dot-com bubble in 2000, that same group averaged just 622%. This surge was sparked by proof that AI could finally monetize. Anthropic's recurring revenue has scaled into the hundreds of millions in record time, while OpenAI is now generating billions in predictable enterprise cash. These figures provided the first tangible evidence that large language models are viable money-printing businesses. But because most application layer AI companies are still private, massive pools of institutional capital sitting on the sidelines had nowhere to go. They were forced into a very narrow track, the foundational semiconductor companies. Localized hardware prices have decoupled from fundamental reality, driven by a surge of capital trapped within this narrow investable universe. This isn't a market-wide delusion, but a highly concentrated bubble in a single sector. Many analysts are now warning of a 2000-style catastrophic crash. However, the deepest underlying fundamentals of the US market suggest a systemic collapse is unlikely. Unlike the dot-com era, today's tech leaders are backed by rock-solid demand and massive earnings. In the most recent season, 84% of companies beat earnings per share expectations, crushing historical averages and proving that corporate profitability remains exceptionally strong. The macroeconomic foundation provides an additional buffer. The U.S. labor market remains resilient, adding 115,000 jobs in the latest report, while manufacturing and services indices continue to stabilize in the expansionary zone. To navigate these conditions without falling victim to the volatility, you need a resilient strategy. I invite you to check out the SFA Free Stock Investment Masterclass, linked in the description below, to position your portfolio for what's coming. While the broader US economy has a strong floor, the overextended semiconductor sector is highly vulnerable. It has run too hot and is now searching for a catalyst to trigger a correction. Every irrational rally eventually undergoes a detoxification process. Overbought sectors usually require an external shock to shift market psychology and force capital to rotate into more reasonably priced areas. The first major risk is the resurgence of inflation. Crude oil has stubbornly remained around the $100 per barrel mark, creating a persistent structural weight on global supply chains. Expensive oil acts as a tax on the entire economy, driving up logistics and raw material costs. If these prices remain elevated, they will inevitably begin to erode corporate profit margins across retail, manufacturing, and transportation. The second risk is the transition of power at the Federal Reserve. On May 15th, a new chairman takes office, and Wall Street is currently flying blind regarding his specific communication style and policy leanings. Cautionary: this transition comes at a time of deep internal division within the Fed board. These frictions guarantee a high volatility environment as we approach the critical June 17th policy meeting and the release of new economic projections. The third risk is the political uncertainty surrounding the impending elections. The market is already beginning to react to potential shifts in trade policy and tech regulation. Historical data shows that the stock market often struggles during the middle months of a midterm election year. Legislative uncertainty and intense partisan battling create a wait-and-see environment that often precedes a pullback in equities. These three risks, inflation, the Fed transition, and political volatility, represent the specific catalysts required to shatter market sentiment and trigger the semiconductor correction. As the hardware bubble limits, institutional money rotates to the AI application layer. The runway is staggering. Fewer than 25% of corporations have integrated these tools. Backed by massive revenue, model developers are now generating billions in high-margin software income. The primary beneficiaries of this shift will be the cloud infrastructure providers hosting these models, and the enterprise software companies successfully rolling out AI features to their existing massive user bases. This unpriced software boom is set to become the primary growth engine for the S&P 500. As hardware cools, the application layer will drive the next secular bull market. My strategy is not to panic sell foundational tech holdings. These are generational assets. Instead, I am using options to hedge against a hardware correction while keeping my core positions completely intact. Offensively, I am positioning capital ahead of the herd. While the market remains fixated on hardware, many high-quality software companies are trading at attractive discounts. This is where the smart money is moving right now. I release these macro deep dives every month to help you stay ahead of these rotations. Make sure to subscribe and check out the Masterclass link below to learn how to identify these setups for yourself. Generational wealth isn't built by following the crowd into an overheated top. It's built by objectively tracking the flow of capital and positioning yourself exactly where the next wave of revenue is about.